Okay, and oil prices. So let's use the basic supply-demand graph analysis, the microeconomics, to analyze the effect of shifts in supply and demand on the prices of oil. So the first is going to be supply-side shocks, either negative supply-side shocks or positive supply-side shocks. So first we're going to start out with supply and demand in equilibrium at the quantity and the price. If the supply curve shifts out and shifts down, then quantity decreases and the prices drop. If the prices drop, then you are going to write forwards, or you're forecasting prices to drop. You're going to write forwards, write futures, write calls on futures. You're going to buy puts on futures. You are going to sell short. You are going to write calls and buy puts on the ETFs and on the oil company stocks. If there is a negative supply shock, a disruption in the supply chain, and the supply curve shifts back, then the prices are going to go up. If you are forecasting the prices to go up, then you are going to buy forwards, buy futures, buy calls on futures, write puts on futures on the indexes. You are going to, for the ETFs and the oil company stocks, you are going to buy on margin, buy calls, and write puts. So let's look at the supply disruptions or overproductions, the shifts in the supply curve out first and then back second. So if actually I take that back. We're going to look at the supply constraint first, the shifting of the supply curve back first and then out second. So back first. What would cause the supply curve to shift back and cause prices to go up? Well, the first thing is disruptions in the supply chain. Middle East unrest, blowing up or taking of the oil wells, reduction in fracking production or permitting or pumping or closing down of the wells, OPEC's coordinated policy efforts to negotiate that all OPEC countries will reduce their production in the future, and maybe there's some other factors too. The other is overproduction that pushes out the supply curve. That could be increased fracking. Right now, the United States exports oil for the first time ever. So high fracking levels, continuation of fracking will continue to pump new supply into the market, putting downward pressure on prices. You also have OPEC. Even though OPEC has said that they are going to do a coordinated effort to pull back on production, a lot of the members will cheat and say that they will reduce production, and they actually don't, and they end up trying to sell in to the marketplace at the higher price, thereby getting a free ride or free rider problem in regards to OPEC coordination. And then lastly, you have Iran, which has signed off on the nuclear deal. Europe's approved it. The theocracy under the Ayatollah has approved it. Congress is going to approve it here. So once that is signed, Iran will now be able to pump more oil and deliver more oil in the global oil markets, which will shift out the supply curve and put downward pressure on oil prices. Let's talk about the demand factors right now. So the demand for oil over here, okay, we're going to look at again, we're going to go back into the microeconomics. We're going to start in equilibrium. We're going to have supply-demand graphs, and we're going to now shock the demand curve, either positively or negatively. So first, if there's a demand shock, the demand curve shifts out and prices rise. If you're forecasting prices to rise due to increasing demand, you're going to buy forwards, buy futures, buy calls on futures, write puts on futures. You are also going to buy on margin, buy calls, write puts on oil company ETFs and oil company stocks. There could also be a negative demand shock, i.e. a recession could occur, which means that the demand curve is going to shift back. That's going to lower prices. If you are forecasting a recession or negative demand shocks, on prices and you're forecasting prices to go down, you are going to write forwards, write futures, write calls on futures, and buy puts on futures. You are also going to sell short, you are going to write calls, and you are going to buy puts on oil company ETFs and oil company stocks. So let's look at what could cause the demand curve to shift. One would be high and rising global demand or gross domestic product. Higher consumption by businesses and individuals, higher government purchases, and higher gross domestic product production, so higher purchases of oil that go into the production process. And then also, which could also have an effect on the prices, will be energy efficiency, but that will be on the lower falling demand side. So this actually goes down here. Okay. So in low and falling demand, so negative demand shocks, it's going to be the opposite of this. So slow and declining gross domestic product, lower consumption levels, lower government purchases, lower production of goods and services, and then higher overall energy efficiency, and the substitution effect between alternative renewable energy and petroleum-based products and oil carbon substitution. So that's oil prices. Now let's talk about gold prices. Hold on.